Chapter 7: Exposing the Strategy. In this chapter we will have a look at the strategy the gold cartel uses to suppress the price of gold. But before we can do that, let's first have a look at the markets gold is traded on a daily basis around the world. Basically, 4 markets around the world trade gold and determine the spot price of gold. Those markets are the Hong Kong market, the Sydney market, the London market and the New York market. The London market is the major gold market where 95% of the total amount of physical gold traded around the world changes hands. The New York market is the major paper gold market of the world. Twice each business day, 5 members of the London Gold Market Fixing Board determine the price of gold. This determination of the price is done on 2 specific times of the day and is called price fixing. Although the term might be misleading, this price fixing has nothing to do with price capping or manipulating. The London AM and London PM fix are used for settling contracts between members of the London bullion market, but informally the gold fixing provides a recognized rate that is used as a benchmark for pricing the majority of gold products, contracts and derivatives throughout the world's markets. The London PM fix is the major benchmark for daily gold-related trades. When comparing the intraday spot price of gold trading on the New York market to the spot price of overseas markets, we can see something remarkable. Looking at this chart between 1993 and 2002, gold on the New York market almost without exception traded lower than on the markets in the rest of the world. How could this possibly be? If you take a period of 50 days and on 48 of those days gold closes lower in New York than in London, you know something is wrong. So what are the chances New York at random closes lower than London 96% of the time during a 10-year period? Let's have a closer look at what is happening here. Here I will show some random pictures that show sharp drops in the price of gold on a daily basis. It's very hard, if not impossible, to tell for sure if these sharp price drops really are the signature of the gold market, of the gold cartel, and are just normal market forces at play. There can be found dozens more of similar examples that I've shown here. When studying the intraday price movements on the gold market for a longer period of time, you will notice sharp price drops occur more frequently on certain parts of the day than on others. Eric de Carbonell of MarketSkeptics.com has tracked the price drops and has come up with the conclusions represented in this chart. Most of the brutal sell-offs occur on the COMEX. So why is the COMEX the drop zone? When suppressing the price of gold, the best strategy is to wait until the COMEX in New York opens. The London market that opens early in the day is basically a market for physical gold, while New York trades paper, which just represents promises to pay gold. There's a big difference between these two markets. It's easy to manipulate paper because all a government has to do is to create these paper claims of paper promises out of thin air, just like they do all the time when they intervene in the foreign exchange markets. But governments cannot create physical gold out of thin air. So when suppressing the price of gold and use the central bank's gold sparingly, the best strategy to choose is to trade in unallocated gold claims on the London OTC market and supply the market with paper gold derivatives on the COMEX. And you might think an analysis based on a mere observation of daily price actions is highly subjective and could be far from accurate. I, like others, would agree with that assessment, and therefore we can look at something more objective. For years, Dmitry Speck has produced charts that show us the average intraday price actions of gold when all the intraday data on the movement of the spot price of gold is combined. So in the chart that is depicted here, we see averages of the price movement on a daily basis of gold, and it seems clear to me a distinct pattern emerges from this. The pattern I read is that the price of gold is suppressed at the following psychologically important times: the London AM fix, the London PM fix, the opening of New York, and the closing of New York. At these times, the gold cartel on an average basis is most active, so it's clear that the New York market is the most prominent market in the gold suppression scheme. Gold and the business cycle. So it seems the gold cartel uses a clear intraday tactic to suppress the price. Now let's have a look if there is also a long-term strategy and under what kind of circumstances the gold cartel becomes most active. Dmitry Speck has done great work correlating actions in the price of gold with Dow Jones lows that were recorded throughout the last 15 years. Let's have a closer look at his findings. When the Dow plunges, panic spreads on the stock market, so when looking for a safe haven, where do you turn your attention towards to? In this scenario, gold would be an excellent candidate. So when stock markets are in free fall, it shouldn't be a surprise when seeing the price of gold going the opposite direction. But correlating the Dow Jones lows of the last 15 years with the price of gold 3 months before and 3 months after these lows, a different picture emerges. When the Dow drops sharply, gold falls as well, and even after the Dow hits its low, gold for the last 15 years bottoms over half a month later when the Dow already has put a clear leg up. Although it is reasonable to assume investors in panic mode who just lost profits in the breakdown of the stock market lock down their remaining gold profits by selling gold, but should this account for the price action for all of the price action we see in gold? It is surely no historical well-established pattern that in times of crisis where the Dow Jones drops sharply, the price of gold drops as well. Could it be that for the last 15 years, especially at times of crisis on the stock market, actions were taken to reduce the appeal of gold as a safe haven by suppressing its price? It's hard to tell for sure, but at least we can say that especially at times of crisis, financial institutions desire falling gold prices and there is an incentive to suppress the price of gold. For in order to re-stabilize the stock market, you have to make sure investors' money flows back to stocks. And when this money flows to gold instead of stocks, governments, bonds and central bank created fiat currency, the monetary system that serves the establishment, suffers a serious blow. So suppressing the price of gold and pumping extra liquidity into the stock market from the time the stocks plunge until the stock market has bottomed seems like an appropriate thing to do when restabilizing the stock market. Therefore the price of gold has to be suppressed till after the stock market has hit its low and the panic is over. Judging from the previous chart, this could well have been happened over the last 15 years. So now let's take a look at the year 2008 when Bear Stearns collapsed, IndyMac collapsed and the Lehman bankruptcy triggered the economic crisis that plagues the world until the present day. Again, Just after each of these major events, the price of gold dropped. So has gold lost its appeal as a safe haven, or does this chart of 2008 indicate the coordinated efforts of the gold cartel to prevent gold from attracting the investors' money needed for restabilizing the market? I let you decide.